Welcome to the Allan Small Financial Show. Thank you for taking the time to share with us out of your busy day. We always love when you can join us. We have a very busy show this afternoon. Anytime we have a show right before the Fed is about to speak in the United States and set interest rate policy, it's always exciting. And they're going to be talking to us, or at least giving us their outlook for the U.S. economy and what they see with respect to interest rates in the next couple of hours, I guess just under 2 hours. So a very, very exciting day, lot to cover. So let's get to the show's topics. So today we're going to talk about the banking turmoil. I think a lot of you watching this afternoon have been wondering about banking turmoil, what's going on in the US, what's happening in Europe with respect to Credit Suisse and unfortunately their demise. Can something like that happen to us here in our country? So we're going to touch on that. Should Canadians be concerned about our banks? We're going to always go through the This Week topic, which is where we discuss what I believe is important for individual investors to consider before you make your investment decisions over the next couple of weeks. We have a couple of very timely topics there. We're going to speak a bit about confidence. Why is confidence so important? Well, over the last few weeks, I think individual investors have had their confidence rattled a little bit. I've talked to a number of people and they've asked me, how safe is their money? How safe is their bank deposits? So I think confidence has been rattled, I guess, in this country, as well as all around the world with what's going on in the US and their banking system. Tech stocks, have they or are they a safe haven for investors? We've talked about tech stocks really since the start of this year as being the place to be and where the growth is for individual investors. Is tech stocks or are tech stocks a safe haven? We'll touch on that. Oil prices. Oil prices have dropped tremendously over the last little while. In my opinion, I think the leading factor as to why inflation in this country has fallen as much as it has. So we'll talk about the oil price and what's affecting the price of oil today. Canadian economy snapshot. How is our economy doing? What's going on with our country? Are things going in the right direction? Since the Bank of Canada really has been on pause for the last, I guess, few meetings, has this been the right strategy? Has our economy continued to grow, even though the inflation levels are still elevated? We'll talk about the Canadian economy. And lastly, we'll get to your questions. Your questions on anything you have. Please, if you have a question during the show, put it into the chat box that you have on Facebook or YouTube. You can always send us a question. Hope to get to as many questions as we can for the end of the show. So without further ado, let's move on to our first topic. So I guess everybody around the world has been watching the U.S. banking system for the past, well, at least 2, 3, maybe even 4 weeks. We got wind of what was happening down in the U.S., I guess around that time, about 2, 3 weeks ago, maybe a little more. And I think a lot of individual investors, a lot of individuals in general, walking the streets of Toronto or anywhere in this country are wondering, how safe are our deposits at our major banks? Well, the first thing I wanted to touch on is to say, yes, your deposits are safe. I think there's a very big difference between the banks that are having difficulties in the United States with our banks here in our country. Keep in mind, there are a lot more US banks than there are Canadian banks. And if you look at statistics, over 500 US banks have actually failed over the last 10 years or so. So you're kind of wondering, well, why is this happening and how can a bank fail? Well, overall, these banks tend to be smaller in size, regional or community banks. Silicon Valley Bank, which has been in the news for quite some time now, the one bank that failed down in California. We had Signature Bank running into difficulties in New York State. These are two smaller banks. But the Silicon Valley Bank, the one that has gotten most attention, that was a very niche bank. It was a bank for startup companies, in particular, startup technology companies. Venture capital put a lot of money into Silicon Valley Bank for these businesses to start up. As we know, as interest rates rise, it unfortunately hurts technology. So what Silicon Valley Bank ran into was a slowdown of business. There weren't as many companies going public. There weren't as many startups. Technology in general was getting hit pretty hard last year. So Silicon Valley Bank lost a lot of business. The other major factor that caused the turmoil or I guess, the fear in these banks has been this idea of the Federal Reserve raising interest rates as fast as they have. Now, this goes for all banks in that we've seen a lot of bank deposits leave banks and go to other areas paying higher interest. So when the central bank, Federal Reserve or Bank of Canada, raises interest rates as fast as they have, people that have money sitting in a savings account, they say, well, why should I keep my money in a savings account making next to nothing when I could go out and buy government bonds paying 4 or even as high as 5% on a 2-year bond, for example, in the US? So started leaving bank savings accounts. So when you're a smaller bank, that presents a lot of difficulty because you start seeing your money leaving your bank. And when you're a smaller bank versus a larger bank, that presents a problem. You basically have a run on the bank. Your liquidity situation, it dries up. And the end result, unfortunately, for Silicon Valley Bank was that they had to go under, and their assets in the end, or their deposits, had to be guaranteed by the federal government in the United States. For a larger bank like JP Morgan or Bank of America, or even our larger banks up here in Canada, TD, Royal, Scotia, yes, they will too lose savings or lose bank deposits, but they are so large, they can weather these types of storms. And in fact, when there is a run on the banks, it tends to be with the smaller banks. People have fear and they end up putting money with larger banks. So you can see here, there's a couple of charts I wanted to show you. The first one is the shares of regional banks, or what I call community banks down in the US. You can see First Republic Bank, probably one of the banks that had most difficulty and still is having difficulty, even though the government has stepped in. Other major banks in the US have stepped in to give them money to stem the tide during these difficult times. You can see their stock prices have fallen quite a bit across all regional banks, but First Republic has fallen the most. You want to compare this to one of our banks, Royal Bank, as an example. There's a chart on Royal Bank, and you will see that Royal Bank too had their share price fall, but not nearly enough. And you can see this Royal Bank towards the end of the chart, you see the stock price really start to tail off. But again, it went from about $140 a share to about $130 a share. So it lost 5 to 7% of its share value, but not nearly as much as a regional bank. So overall, I guess the message is very clear. If you are here in our country, you have 5 major banks, 6 if you count National Bank. There are other banks like Laurentian, Canadian Western Bank. These are larger banks in general, and I don't believe there's any fear that your deposits, that your savings is in jeopardy. If you go to any of our banks, you will be able to access your money. There's actually never been a time in history where our banks stopped paying dividends. Ever since we've been keeping track since after World War II, our banks continue to grow over time, grow deposits over time, increase dividends over time, which means their profitability is good, and they've always paid those dividends, and they will always be there to pay you your money when you go to the bank and you try to access your savings. So I had a few people that asked me, what's going on in the US? Can that happen here to our banks? I would say the answer is no. And even in the US, keep in mind, federal government did step in to guarantee these bank deposits, even in these small regional banks. So even those in the US that might be looking at the show, watching the show today, your deposits are now secure as well. And they're trying to come up with ideas as to what should be insured. In the US, each bank account is insured up to $250,000. Here in our country, it's about $100,000. But they're looking at increasing that in the US, and maybe we'll look at increasing it here in our country as well. So overall, are Canadians, or should Canadians, be fearful or nervous as to what is happening down in the US if it could come up here to our country? I guess the quick and logical answer is no. I think it's full steam ahead. And I would say that this may present a buying opportunity for those that are interested in buying these banks on the cheap. is the part of the show where I talk about what I believe is important for individual investors to think about before you make your investment decisions. And I always pull out three topics for everyone to consider. Sometimes they're macro, sometimes they're more company specific or micro. Today, we have a bit of both. We're going to talk about Fed strategy, what the Fed is going to say a couple hours from now, and what they're going to, I guess, say about the future. Will they continue to raise rates as aggressively as they have been, or has this bank crisis taken a lot of steam out of how they feel about the economy? We also are going to talk about U.S. inflation. U.S. inflation is definitely something you need to keep an eye on before you make your investment decisions. If we see U.S. inflation start to tick higher once again, that obviously will be a bad thing for the stock market, and that could cause the Federal Reserve to raise rates even further. Here in our country, we've been on pause for quite a while, for the last couple of meetings anyways, with respect to rising interest rates. But again, if we see inflation numbers in our country rise, that would mean that the Bank of Canada could be forced to start raising interest rates here again. So keep an eye on that. The second topic we're going to touch on are bond yields. I think everybody should keep an eye on what the bond yields are doing. In the US, we've seen bond yields crash down over the last few weeks. The 2-year bond yield well over 5%, now just above 4%. It actually got below 4%. So bond yields, interest rates, these are things that need to be watched before you make your investment decisions. And lastly, stock valuations. Which stocks make most sense at this point in time to move your money into? You got to take a look at the charts. You got to understand what's going on internally at these businesses. And you have to understand what's going on with respect to the macro. And is the macro causing stock valuations to be lowered, even though the underlying business itself is doing quite well? In which case, I would say that could be a buy opportunity. So stock valuations is something to consider as well. So let's touch on the first topic, Fed strategy and US inflation. So you can see here, we have a chart we'll pull up in a second. US inflation numbers have now dropped to 6% in the United States. Core inflation is still staying stubbornly high, 5.5. What core is the number that you get once you X out volatile food and energy. Now, I really don't like to X out food and energy because those are the two main things that affect us every day, price of food and the price of energy. So I always look at the core number. And to me, you're seeing actually the core, when you see 5.5, why that is only slightly below the overall number. To me, that just means that a lot of the inflation that we've seen come out of the system, out of the economy in the US, and even here in our country, is because oil prices have fallen so much. So when you don't factor in falling oil prices and you look at other parts of the economy, you can see that inflation is staying stubbornly high. And that, in my opinion, is why the Federal Reserve continues to want to raise interest rates going forward. So at 2 o'clock this afternoon, the Fed will tell us what they're going to do. They're going to either raise a quarter point. They could basically pause and say, based on what's going on in the world today, we're going to take a more of a wait and see approach. I don't think they're going to raise 50 basis points, even though about 2 weeks ago, the talk was that they may raise 50 basis points, but I think that's off the table now. So overall, you want to take a look at what's going to happen at the meeting this afternoon. You want to understand what they're saying. The stock market's going to parse through every word the Fed says, every pause, every intonation. It's kind of silly at some point, but I think the Fed is going to raise 25 basis points, and hopefully they'll take on more of a dovish tone, a tone that says 25 and perhaps maybe indicate that they may pause for the time being until they see this banking situation play itself through. So they're going to do at 2 o'clock. But again, once Jerome Powell has his speech, all the Fed officials will probably speak in the coming days, and each of them will have their own opinions. And that, unfortunately, will move this market. And for individual investors, yes, it's kind of a whipsaw effect, but you need to watch what the Fed governors are saying, what the inflationary data is telling us. It's definitely coming down in the US, but nowhere near their 2 to 3% mandate. Second topic that I think individual investors need to focus on, as I mentioned, are bond yields. And you could see here The bond yields that we have up, there is the 2-year bond yield, which we'll show you. And you can see how much the bond yield has fallen. And that is based on the banking situation in the US, the banking crisis, if you will. The 2-year prior to the banking crisis was over 5%. If we scroll down a little further, or we can show the 10-year bond rate, that now is under 4% at 3.6. That actually got as low as 3.5, 3.4% recently, and it started to tick a little bit higher now that federal government in the US has come in to save the day and guarantee these deposits at these banks. So now we're starting to see bond yields move higher. I think the 2-year got down to actually under 4%. So what does this mean for individual investors? Well, once upon a time, higher yields meant not good thing for the stock market. The higher the yield, the more competition for the stock market. Why would somebody want to buy a dividend-paying stock paying 4% when they can make 5% on a low-risk 2-year government bond? Today, I think it's a little different. Today, I think higher interest rates means a healthier economy. And maybe the stock market actually wants to see higher rates, maybe not too high, but higher than where they dropped to recently. Because when we see interest rates drop as quickly as they did, as low as they did, that usually means there's something going on, something wrong in the economy. So once again, we don't want to see too hot. We don't want to see too cold. We want to see bond yields just right. So if bond yields tick up a little bit from their recent lows, I think that's a healthy sign. I think that's a sign that will tell individual investors that this banking crisis, or at least the worst of the banking crisis in the US, could be over. The worst of the banking crisis in Switzerland, with Credit Suisse being taken over by UBS, the 2 largest financial institutions in that country, could be over. So I think higher yields on the 2-year and 10-year in the US could be actually a positive sign. We just don't want to see them get too high. So keep an eye on bond yields. Last but not least, the third topic that I think individual investors need to focus on before you make your investment decisions is an obvious one, and it's one we talk about all the time: stock valuations. Where are the cheap stocks today? Well, if you're saying bank stocks, you're 100% correct. Bank stocks have sold off quite a bit. And I know individual investors are asking me, why are our banks selling off? We have nothing to do with what's going on in the US. Why is Bank of America, JP Morgan, 2 of the largest banks in the US, selling off if this is a problem with smaller regional or community banks? The answer is very simple. When you look at ETFs or bank ETFs, ETFs are a basket of many different banks. In baskets, you will have Canadian banks, US banks, different banks around the world, European banks, Asian banks. And so what happens is when there's a banking crisis in the US, the largest economy in the world, investors tend to sell off not only individual stocks, but also these ETFs. So if you're a bank here in Canada, Scotiabank, and you have nothing to do with what's going on in the US, but you're a part of this ETF, you're going to see your stock price sell off as well, because the ETF or basket of banks has sold off in sympathy with what's going on in the US. However, in my opinion, that gives us great buying opportunities. So let's take a look at a few charts here. We have one of Bank of America. You can see how Bank of America chart, there it is, has sold off substantially. It's down probably close to 40%, in and around 40% from its highs that we saw just over a year ago. We have another chart here of Wells Fargo, another very large US bank. They're under $40 now. They once were as high as $60, as you can see in the far left of this chart. So here are 2 large US banks that I think represent fantastic value, opportunities for individual investors to get into these banks, get a little bit of a dividend. Both Wells Fargo and Bank of America pay just over 3% dividend, but an opportunity for growth. When everything settles down in the coming days and weeks, then I think these banks will gain a lot of their value back. A couple of Canadian bank stocks to highlight. One is one of our largest bank stocks, TD Bank. TD Bank, second largest, arguably the second largest in our country. You can see how much that bank stock has fallen off. Once $109 a share, now under $80 a share. Wow. this bank is now paying close to a 6% dividend. I think a great opportunity for conservative investors, not only to make a great yield or good income from the dividend, but also great opportunity for growth going forward. And I think our last chart here from a bank is Bank of Nova Scotia. I've been bullish on Bank of Nova Scotia for quite some time. They're down as low as $66, $67 a share, down from the mid 90s not too long ago, just over a year ago. Again, their yield is over 6% and a great opportunity for growth. So looking at stock valuations right now, there is no doubt that valuations or great bargains are in the banking sector. You could look at large US banks, you could look at large Canadian banks, you can even look at some of the larger regional banks like PNC Financial. PNC Financial, one of the banks that actually lent money to First Republic Bank to help them out in this difficult time. So obviously they have a lot of cash on hand, yet their stock has been cut by more than half, more than 50%. So a name like PNC Financial represents tremendous value, in my opinion. Again, as long as you're an investor that can handle the volatility of owning a bank stock, there are a lot of great bargains, great stock valuations in the banking sector. Confidence. Here's where I want to talk about individual investors' confidence. And I think a lot of people's confidence has been rattled over the past year and over the past month. Last year, coming out of 2021, such a great year for the stock market, for individual investors, growing portfolios. We had a snag in 2022. We came into an environment, higher inflation, causing central banks around the world to raise interest rates and raise them in a hurry. And that obviously was a recipe for, I don't want to say disaster because it wasn't a disaster, but it was obviously something that the stock market didn't like, couldn't get past, at least initially. And so the S&P 500 last year lost roughly 22%, or it was off 22% from the highs. So coming into this year, there were a lot of bargains. Individual investors got excited again about some of the growth ideas. We heard a lot about things such as artificial intelligence and all the opportunities in the tech space. And then what happens? We get hit with a banking crisis in the US. We've seen crisis in the US before, obviously, some smaller crises, but the big one was back in 2008. We had the big financial crisis when that was a lot different. That was more in the mortgage area or the lending area for big banks. They were lending money to individuals that really shouldn't have been borrowing money, and they're out buying homes. And so when things started to fall apart, we had a very big issue in the US, and that was a lot deeper than the crisis we're going through currently. But having said all of that, individual investors have seen their confidence fall. I've talked to a number of people that they've said to me, Allan, I'm going to hang on just another few months. I want to see where this banking issue goes. And if it starts to get worse, I'm just going to move to cash. And to me, I think that's the wrong thing to do. As I've said on this show, you can never time markets. A lot of confidence has to do with volatility. So with that in mind, I want to pull up a chart of the VIX, which is the index for volatility. And you can see here that in the month of March, how high volatility spiked. And you can see also as fast as it spiked, it's coming down just as fast. So when people lose confidence, they're losing it because volatility in the stock market is at high levels. I actually believe, if I'm not mistaken, the VIX got as high one day for at least a short period of time to almost 30. And that's when people look at volatility and take a step back and say, oh boy, that's high. Anything under 20 tends to be less volatility, and investors are more comfortable. Anything above 30, investors can and usually begin to panic. So confidence is something I think is important. And when you're calling into question banks, which are the bloodline, as I've said many times, of any economy, and you're wondering if your deposits are safe, if your money is safe, Can you make payroll? Can you pay your employees? Do you have money there to take out to spend, to buy groceries, to fuel your car, fill up your car at the gas station? That's when confidence is eroding. Now, I believe confidence will come back. I think this banking crisis is well on its way to being resolved. I don't think it will spread. I don't think there's a contagion here. I also believe that inflation is going to continue to fall. I think we've seen it down from 9% to 6% in the US, from 8% to 5.2% in Canada. And that's going to help build back confidence. I think once people realize that the economy is healthy, resilient, and doing well, I think this will lead to people's confidence coming back, people's confidence in investing coming back. And in general, I think it's going to cause a happier environment here in our country and in the US. So has tech become a safe haven for investors? I spoke on previous shows about tech many times, and coming into 2023, tech was, as I've said many times, the hardest hit area in the previous year. So it makes sense that a lot of individual investors would be looking to buying tech on the cheap as a good value investment. Now, how many times do you hear that, right? Tech being called value, but really it is. And when you look at where the problems are in the economy today, in the market today, you look at banks, you look at interest rates, you look at cash, who has the cash, where the cash is going, where the money is moving to. And so you can't help but to notice that it's the big tech names that are flush with cash. It's the big tech names that have billions and billions of dollars to spend, to make acquisitions, to grow their business, to put towards future potential like artificial intelligence or the cloud. So when you look at why tech is actually or has behaved as a safe haven, hasn't gone down as much as many other sectors in the economy, being flush with cash is one of the main reasons. Another main reason is interest rates. When you see interest rates moving higher, as we did in 2022, that affected the stock market, and in particular, technology stocks. Interest rates higher, tech stocks were selling off. So what have we seen so far this year? We've seen interest rates falling, not moving higher, going in the other direction. So obviously, money's been flowing back into tech. So it's been having the opposite effect. Low interest rates, lower interest rates, and tech stocks moving higher. Even if interest rates start to move back, I think you can make the case that they're probably closer, they meaning the Fed and Bank of Canada, well, Bank of Canada is already on pause, but the Fed is closer to the end of the higher interest rate cycle or the hiking of interest rates than they are at the beginning. And again, you can make the case to buying tech stocks on that premise. So let's take a look at a couple of tech stocks here that I think have acted as a pretty good safe haven for investors. First one is Meta. Meta, or as some of you may know it as, is Facebook. You can see how much Facebook has risen off the bottom. We were as low as $80 on this stock, and now it's over $200. So anybody who had the iron stomach to buy into Meta or Facebook under $100, you pretty much doubled your money recently. Moving to another name, Microsoft, another of the big tech names, the big cap tech, one of the largest companies in the world. You can see how much Microsoft has bounced off the bottom. At one point, Microsoft was down 220 in that range, now all the way up to 270. So two names that I think are great. Two of the best companies in the world. A couple of names on the chip side of things with the talk about artificial intelligence and gaming and automotive. Got to look at AMD. AMD is a name that $96 was as low, I believe, somewhere around $80 a share. So up quite a bit over the last few months. And probably the biggest mover out of all the chip names, NVIDIA. NVIDIA chips is basically what's going to power artificial intelligence going forward. And we heard from the CEO yesterday, Jensen Huang, talk about how NVIDIA is set up to take the world to the next level in artificial intelligence. And it's going to be powered by NVIDIA chips. And that's why we've seen NVIDIA go from about $120 stock to a $262 stock in the last little while. So tech has definitely been that safe haven for individual investors. Not only you can hide out in there for the last couple of months, getting through some of the banking situation, the banking crisis, but you've also not only been hiding out in tech, if you have been, you've also seen tremendous growth, especially in some of the big cap tech names and some of the chips. So going forward, I think you can continue to look at tech as that safe haven while we get through this banking crisis. But I also think once we're through the crisis, tech will still behave as a growth engine for individual investors. Wanted to touch quickly on oil because I've been getting a few questions on oil, in particular oil stocks. We have a chart we can show on oil and how much the price of oil has fallen. It actually has ticked up above $70 a barrel today on WTI, which is what we watch. Oil has fallen, I think, for a number of reasons, and we talked about them on shows previously. One of the reasons is the growth rate out of China. When you're the second largest economy and you're the largest importer of energy or oil, and your economy is not growing as fast, that obviously is going to affect how much oil you take in. So China growth is affecting the price of oil. I think global growth in general is affecting the price of oil when you have central banks around the world raising interest rates as quickly as they have. They're trying to slow down the economy, and therefore you slowing the economy, the need for energy or oil is not as great, and so price of oil falls. And lastly, when you have a crisis. When you have a crisis, risk assets are off the table. What do I mean by a risk asset? An asset that fluctuates more than others. So when you find that there's a crisis, like there was in the US over the past couple of weeks, the banking crisis, individual investors aren't as quick to put money to work in riskier assets, commodities, or oil. So once again, on the day that we learned about Silicon Valley Bank, First Republic Bank with their issues, although they're hanging in there right now, Signature Bank, Credit Suisse in Switzerland. On those days, price of oil took a hit because individual investors take out their money out of the markets, move their money out of riskier assets, and that too has brought down the price of oil. So going forward, what do I think? Well, I think the price of oil can rise again, not because of China necessarily, not because of global growth, but I think the crisis, the banking crisis that we're going through and hopefully almost finished with, once that is done, I think the price of oil will begin to move higher again. And we're already seeing that happen. Oil got as low as I think 60, 65. Now it's over 70. I wouldn't be surprised to see it in that $75, $80 range in the not so distant future. So if you're an oil investor or if you're somebody who invests in oil stocks, obviously, you have to be careful because it is a very volatile investment, and that's not going to change. But I think you could see some upside. And last but not least, whenever you invest in these oil companies, I think you should look to buy those companies that pay a good dividend. There are many of them. Pioneer, Devon in the US, Suncor, CNQ, Canadian Natural Resources here in Canada. These are companies that are large. They are fantastic companies and pay good dividends. So if you're thinking about making an oil investment, look to ones that are paying good dividends. Our last topic before we get to your questions for this show, I thought we'd touch on the Canadian economy and a bit of a snapshot as to how we're doing. And we have a chart on inflation in Canada and how it's been easing. So that tells me the Bank of Canada got it right when they decided to pause and not raise interest rates anymore. I think they got it right. And you could see here that when you take all items, how low Canadian inflation has gone. As I said, 5.2%, down from a high of around 8%. However, you could also see here with this chart, food purchased from stores. So cost of food, when you go to the grocery store, I think everybody would agree, prices are still high. So that hasn't fallen as much as yet, whereas everything else seems to have fallen. And again, I think a lot of that has come from a bit of a reduction in gasoline prices at the pumps. That has definitely helped a lot of businesses and helped a lot of individuals that travel for business or shipped things from point A to point B. So overall, inflation is coming down in our country. Interest rates are on hold. I think if you look at the unemployment rate, and we do have a jobs chart here, it's a bit of a mixed bag. That's what I get from this chart, job creation in Canada. You can see this past month, February, 22,000 jobs created, well above what was expected. I think it was around 10,000 expected. But look at January, 150,000 jobs were created. In the US, over 500,000 jobs were created in January. In my opinion, a definite anomaly, something that I don't think you're going to see again anytime soon. But that tells me there are a lot of jobs out there. So anyone who's looking for a job should still be able to find one, even though we're starting to see a lot more layoffs in the US and in Canada as well. But I still believe if you're looking for a job, and if unfortunately you've lost a job in one place or one area of the economy, you probably can find a job in another. So going forward, I think Canadian economy will continue to slow. It will continue to slow probably over the next quarter or so, but I think it will pick back up again in the latter half of 2023. Bank of Canada said we may go into a mild recession or just barely skirt by a mild recession. Either way, that doesn't really matter for me because I believe the stock market has already priced in a mild recession, both in Canada and in the US. And so because the market has priced in this mild recession already, I think it's a green light for investors. I think it's a green light for individuals. I think the economy will get better later on this year, but the market will factor this in way before it actually happens. So this is the part of the show where I get to answer a couple of questions that you have, questions from the audience. And I know the show was a little bit longer than the norm, so hopefully we can get to at least one or two. There was a question that came to us, I think last show from Anid. I apologize if I mispronounce your first name. Came through on YouTube. It says, "What's your take on Canadian banks for the rest of this year?" Great question. We kind of touched on that earlier in the show. I think Canadian banks have an opportunity, at least, I guess for the most part, the largest banks have an opportunity to provide tremendous growth for investors. Not only that, I think there's an opportunity to buy these banks so cheaply that their dividend yields are fantastic, 6% or greater, especially if you're looking at a Scotiabank or even a CIBC bank. So I think the opportunity for Canadian banks for the rest of this year is positive. I think we'll get through this crisis in the US, this banking crisis, and I think money will flow back into the banking shares and stock over the next, I guess, for the rest of this year and until these share values get back to where they were prior to the recent crisis. A second question I'll take. I think we have time for one more. Is it more profitable to invest in smaller companies than it is to invest in traditional blue chip stocks? A question that I've not seen before, to be honest. I don't think it's more profitable to invest in smaller companies. I think it's more volatile to invest in smaller companies. Obviously, when you invest in what used to be called blue chip, we don't really hear that term anymore, but larger cap companies, they tend to be less volatile, not move around as much. Obviously, it will depend on what sector of the market those companies are in. If it's tech, if it's oil, if it's whatever the sector is, pharmaceutical, retail, certain sectors of the economy tend to be more volatile than others. But overall, in general, larger businesses tend to fluctuate, their share values tend to fluctuate less than smaller businesses. So I'm not sure you'll be more profitable in smaller businesses. They're more volatile. You can make money faster, perhaps. But overall, in my opinion, I think being in moderate risk or medium to large cap stocks in today's environment should do you just fine if you're looking for growth. So with that, I'd like to thank everybody for being on the show today, or watching the show today, not being on the show, but watching the show. Our next show will be 2 weeks from today, Wednesday, April 5th at 12 noon, as always. And keep an eye on the Fed today at 2 p.m. in about an hour and a half time, see what they have to say. And we'll see where those bond yields go and stock valuations go. And until we meet again, happy investing.